Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Glad you're here. Welcome to Modern Investing Techniques, episode 104. Today is July 12th, 2026. I'm Patrick, broadcasting from Vancouver. Time to break down today's market setup and find our edge. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian TFSA holders eyeing energy exposure should watch Chevron closely, as its GE Vernova joint venture targets AI data center power demand that could lift free cash flow starting in 2027. The S&P 500 closed at 7,575, up 0.4%. The NASDAQ finished at 26,282, gaining 0.3%. The TSX Composite ended at 35,305, also up 0.3%. Geopolitical tensions in the Strait of Hormuz continue to support energy names, while overall sentiment remains constructive. The Bank of Canada decision is due July 24th, with markets expecting rates to hold near 2.75%. And the Fed meets the same week under similar assumptions. Earnings season is heating up with General Electric and Netflix reports due this week. Portfolio benchmark comparison data versus the NASDAQ is not available in today's feed, so we will track that once the numbers return. With energy in the spotlight, let's look at a mechanical way to generate income from quality dividend payers. Passive income ETFs built around high-quality dividend payers offer a mechanical way to compound without stock-picking risk. The approach works by holding a basket of companies with decades-long dividend growth records, automatically reinvesting payouts inside a TFSA or RRSP to avoid immediate tax drag. In today's environment of elevated rates and selective AI spending, these vehicles provide ballast when growth stocks rotate. Implementation is straightforward on Questrade or Wealthsimple. Screen for ETFs with 10-plus year payout histories and expense ratios below 0.25%. Then dollar cost average monthly. The strategy has delivered best results during sideways or modestly rising markets, when yield plus modest capital appreciation outpaces cash. The main risk is sector concentration if the ETF tilts heavily into one industry. Always verify the current yield and distribution frequency before allocating more than 15% of a TFSA sleeve. To get the most from these ETFs, you need to understand the hidden costs that can erode compounding. Imagine you bought a passive income ETF last week at the market open after seeing the Motley Fool list. Your 200-share order filled at the ask price of $42.18. What actually happened is the ETF's net asset value was calculated at the previous close, but the market maker widened the bid-ask spread from 3 cents to 11 cents in the first 15 minutes because two large institutional sellers hit the tape. So your effective cost was 0.26% higher than the NAV. The pro tip most retail investors miss is that limit orders placed at the midpoint during the first 30 minutes of trading often get filled inside the spread once volume normalizes, whereas market orders pay the full widened spread. The biggest mistake with dividend ETFs is assuming the published yield already includes reinvestment friction. Instead, always check the ETF's distribution calendar and set a limit order at least 1 cent inside the current bid before the ex-dividend date to capture the full compounding effect without paying unnecessary spread. That discipline around entries also explains why we're skipping a new trade today despite an interesting catalyst. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. We are not opening a new position today. Chevron's announced joint venture with GE Vernova targets next-generation AI data center power demand, but the setup lacks a confirmed volume spike above the 20-day average and a clear technical entry level. We are watching for a daily close above the 50-day moving average, with RSI on the 14-day timeframe moving above 45. Current price action shows support near the 200-day moving average, but no breakout confirmation yet. Geopolitical premium in energy could reverse quickly if Hormuz tensions ease, which would require a 6% stop below entry to keep maximum loss under 2% of portfolio. The target would be 4 to 8% over a full weekly window if volume confirms. This is low because only one factor, the fundamental catalyst, is aligned. The cold streak regime requires 3 independent confirmations before committing capital. This non-trade demonstrates how to apply the 3-factor gate of catalyst plus volume plus technical confirmation in real time, rather than forcing an entry during a statistically weak streak. Listeners learned that skipping a marginal setup preserves the ability to size properly when all conditions line up. We are watching Chevron for a daily close above the 50-day moving average, combined with volume 20% above the 20-day average before considering an energy sector entry next week. While we wait on energy, here are 4 quick developments worth noting this week. Toyota is shifting Tacoma production to Texas. The move signals potential further relocation of Canadian auto supply chains. This shift could pressure TSEX industrial names tied to cross-border assembly. The recommended action is to trim any TSX auto parts exposure above 3% of TFSA. Proceeds should then rotate into the broader industrials ETF XIU. Details appear in reporting from BNN Bloomberg. The change reflects ongoing adjustments in North American manufacturing footprints. SK Hynix is making its NASDAQ debut with triple-digit AI growth. The memory maker's listing gives direct exposure to high-bandwidth memory demand. NVIDIA cannot satisfy that demand alone. Investors can add SK Hynix using the TSX ticker HXS or the Korea Exchange ticker 000660 via Questrade. The position belongs on the watch list for a post-listing volume confirmation entry. Coverage comes from Motley Fool. The debut highlights expanding access to AI-related memory suppliers. Cambridge Data places Ethereum near the bottom of energy use among proof-of-stake networks. This ranking reduces one ESG objection for institutional allocators. The index measures energy intensity per unit of market value. Ethereum's annual footprint stands at 7.87 gigawatt-hour. Maintain the existing 5% crypto sleeve allocation. No rebalancing is required this week. The information is published on Cointelegraph. Netflix earnings are due July 16th. Subscriber growth and ad tier margins remain the 2 variables the market is watching. The focus follows last quarter's beat. Hold any existing NFLX position. Do not add until post-earnings volume settles above the 20-day average. Reporting originates from Motley Fool. The report date falls within the current heavy stretch of earnings releases. To help you implement these ideas efficiently, here are 2 tools worth checking. The Motley Fool Stock Screener filters stocks by dividend growth streaks. It also screens for payout ratios under 60%. Free cash flow yield above 4% is another criterion. The tool gives Canadian investors a repeatable way to populate TFSA dividend sleeves without manual spreadsheet work. Access the basic screener free at fool.com. The premium tier at $199 per year adds back-tested performance metrics. The source material is the same Motley Fool article referenced earlier. The Cambridge Blockchain Sustainability Index ranks proof-of-stake networks by energy intensity per unit of market value. It helps crypto allocators compare Ethereum's 7.87 gigawatt-hour annual footprint against other POS chains. Exposure can be evaluated before adding holdings inside a registered account. The free public dashboard is updated quarterly at Cointelegraph.com. The index addresses energy use concerns that sometimes arise with digital assets. The dashboard draws from academic and industry data sources. Before we wrap, here is your action item for the week. Open your brokerage platform, pull up the 50-day and 200-day moving averages on Chevron, and set a price alert for a daily close above the 50-day line. Note the exact price level in your trade journal. Before we wrap, keep an eye on energy volume patterns tomorrow, as they could set the tone for next week's entries. That's your modern investing techniques for today. Every episode makes you a sharper investor. Subscribe, leave a review, and we'll be back tomorrow with more market intelligence. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets, each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. Tesla Shorts Time, your daily deep dive into everything Tesla. Find every show free at naranetwork.com. The age of AI puts real builders on the phone with an AI host. Apply at naranetwork.com/age-of-AI apply. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?